Okay, so let's pick them one by one. The first principle, they put it as chapter 1, and they call that objective of a general purpose, objective of a general purpose financial report. Yes, they are the principles. So now, yes. So these all these chapters, they just arranged it in chapters like that. That's how they chose to write their own conceptual framework. So all of them is the principle that they use in developing IFRS. Those are the things they consider, they have considered. Yes, they are the principles. But that's what they called it in their conceptual framework. They call the content, they call the chapters, but those are the principles. Now, chapter 1. During the exam, that's how they will call it too. Chapter 1. Chapter 1. So, objective of it. Why did you go back there? Okay. Objective of a general purpose financial report. Now, the objective of a general purpose financial report says it is to provide financial information about a reporting entity to provide financial information about a reporting entity that is useful to potential and existing investors, lenders, and other creditors to enable them make decision to existing X1 right, to enable them make decision about providing resources. It's long, Abi. It says that what is a general purpose financial report? Is, let me say, a financial report that is used for whatever it is the entity wants to use it for. Okay, meaning that there is no like a definition for a general purpose financial report. So we just call it a general purpose financial report is because we expect it to be used by multiple users. Okay, so multiple users. By the time I'm explaining the objective of that financial report, is a financial report that's for a lot of people. Okay, is not just for a single person, right? Plenty people. So we can say on that basis a general purpose financial reports like that. Okay, but here now, if I say that it's used by plenty people, you will see from this objective, if you look at it, and at your level, I can ask you what's the objective of a general purpose financial report. They can actually ask you, so you have to know this. So they can ask you that what's the objective? It is to provide financial information about whom, reporting entity, that is useful to potential and existing investors, lenders, and to enable them do what? About providing resources to the entity. So let's pick them one by one. The first thing in this definition is what? To provide financial information. That's what financial report is all about. Providing financial information. So there was a diet. They ask you for 4 marks that you should list and explain. They said according to chapter 1 of the conceptual framework, list and explain the financial information that is provided to primary users. 4 marks, like that. So even without me teaching you, what are the financial information do you think we provide, accountants provide to users? Assets, statement of profit or loss, statement of financial position, cash flow, equity, like that. And you're not going in a line. You're talking about assets, creditors, like that. All of those. Any other attempt? Okay, that's the correct one. So in your exam, if they ask you what are the financial information we provide, because they can ask you, don't go and write statement of financial position, statement of profit or loss. Those are the statements that we use to provide those information. That is not the information itself. The specific information we provide are assets, liabilities, income. That's the information we provide itself. So, but the way the conceptual framework puts it, let me give it to you that way so that he said we provide 3 information. That's what the conceptual framework says. Say one by one, we provide information about the economic resources of the entity. That's how they put it. Economic resources of the entity. Number 2, he said we provide information about claims against, provide information about the claims against the entity. And number 3, we provide information about the changes in the claims, or changes in the claims and economic resources. Changes in the claims and economic resources. So look up. This is what the examiner was expecting from you. Now, how do we explain this? What are the economic resources of an entity? Is that what? Is assets. What are the claims against the entity? Those are the liabilities. What are the changes in the claims and economic resources? Profits, something like that. Yes. Yes, income and expenses. Income and what? Expenses. Sorry? Can we say dividend is part of the claims against the entity? No. We cannot. Do you understand that? Why? Why can we say dividend is not a claim against the entity? Again? No, dividend is not an income. Dividends that you pay to your shareholder. But now we are looking at it from the company. So it's not expense. Dividend is not an expense. It's not an expense to the company. That's correct. That's correct. He has said the answer. He said the company can decide not to pay dividend, even if they make profit. Even if they make profit, it's not compulsory they pay dividend. They can retain it. So it's not a liability to them. But immediately they declare dividend and we expect them to pay immediately, right? We expect them to pay. So if they are not paying, then instead of crediting bank, then they will be crediting dividend payable that will show under current liability, right? That's what will happen. Then it can become liability at that point. Though. Secondly, we already know the financial information we provide about a reporting entity. I'm not going to talk about this because we are going to talk about it in chapter 3. That is useful to potential and existing investors, lenders, and other creditors. There was a diet. I can ask you, was it this place R or CR? They asked that you should list the primary users of financial reports according to chapter 1 of the Conceptual Framework and their information need. Right? When they say primary users, these are the people that are listed here. Potential and existing investors, lenders, and other creditors. So the next thing we can pick from this objective are the what? Not just the users, the primary users. Because they listed these three people. But looking at it, are these the only users we have? There are other users, but they listed only these three. So that means they are secondary that we are not focused on. Because from what they are saying here, that these are the three set of people we provide financial information to. Those other people, they are none of our business. They are secondary users to us. So the primary users of financial statement are investors, lenders, and what? Other creditors. Both potential and what? Existing. But the question then becomes why? Why did they go for these people? Why are these people the primary users? Yes. Other people, other users like the government, international community, employees, those ones who wants to make decisions. But why did this objective specify just these three people as the key users? Say it again. Okay, I think that's it. They are the one giving the company money. Yes. Stakeholders, I mean, they are the providers of capital. Without them, the company cannot exist. It's not possible. So, and that is why our focus is on this three. And all IFRS has these three people in mind when we are presenting our financials. Yeah. Exactly. That's who the investors are, the shareholders, lenders, the bankers, other creditors, your suppliers. These are the people we have in mind. They are the primary users. And all IFRS I will teach you, they focus on these people. Because that's the principle. That these are the people we are providing the information to. So the investor now, what will the investor use this information to do? Meaning that what decision will an investor make when we provide them this information about our assets, liabilities, income, and expenses? What decision will the investor make? Yes. Yeah. Thank you very much. So they make decision about whether to buy or sell shares, Abi? Any other one as regards investors, apart from buying and selling shares? Yes, you are very correct. That's one of the decisions they make. Any other decision that they might want to make? That's not decision. Now that is already in the books. That will be in the books already. That's not the decision. They are not the one that will determine the return. Okay. So is that a decision? What is it? And now, so that's to buy or sell shares. Yeah. Someone was saying something. Okay, the security of their investment in their company. Is that a decision? Is that not in the books already? Is that a decision? Well, that now that's what probably maybe they should sell their shares. Okay, by the time you give them your financial, I mean, would that see? So there are two major decisions they will make. Number one is whether they should buy or sell shares. Okay, the issue of whether the company is profitable, whether the company is liquid, that one is not decision. Those are that's the information itself. So the second decision they might want to make is whether they should vote to retain the management there, or whether they should fire them. Right? Yes, they are voting right. Yes, they are voting because they are vote. They are the owner of the company. So what we want to hear from you are the decision they would make, not what is in the information. Like whether the company is profitable or not. No, it's there in the information. Whether the company is making profit or not, it's there like that. So that's that. The lenders, those ones, obviously, they will make decision on whether they should continue to lend them money or recover what they have given to them. The other creditors, who are the suppliers, those ones make decision whether they should provide trade credits or whether they should stop giving them trade credits or whether they should even give them discounts, something like that. So those are the decisions this guy would make. They are very important. Those are the people the information are actually meant for. And that's chapter 1 of the conceptual framework. Before I forget, I almost forgot. This information, they are presented on an accrual basis of accounting. They are presented on what? Accrual basis of accounting. And what's accrual basis of accounting? I'm sure some of you might have heard of accrual basis of accounting before. You want to try? Okay, so she said you recognize income when they are earned, not when cash is received, and you recognize expense when they are incurred and not when cash is paid. Okay, well, so what happens when you collect money and you have not earned the income? And you have not earned the income, does that mean you will not recognize it at all? Does that mean you will not recognize it? Because that is what your definition is saying. But you see, I've recognized it. Does that mean you're not following a accrual basis? So that definition you gave me is elementary. Yes, yes, which is not wrong, but it's not complete. Now you're in a skills level. You need to understand that it's not just about that, it's actually beyond that, and it's simple. See, the meaning of accrual basis of accounting is that you recognize this information, assets, liabilities, income, expenses, when the transaction has occurred. Immediately the transaction occurs, recognize it in your books. That is accrual basis of accounting. So immediately there's a transaction, recognize the impact in your books immediately. So whether you have received money, whether you have not received money, no, that's not the issue. As soon as there's an origination of a transaction, recognize the economic impact in your books. Okay? So that's accrual basis of accounting. You recognize assets, liabilities, income, expenses when the transactions what? Occur. That is even easier to remember. Okay, let's go to chapter 2. Everything I've talked about here, one way or the other, I can have asked them before. They love asking those areas. Qualitative characteristics. Qualitative characteristics of a financial report. Abi? That's chapter 2. Qualitative characteristics of a financial report. So now, this chapter 2 is talking about the qualities, the attributes that a financial report would have. So what's the principle around that? Because when they are developing IFRS, as you will see, most of the IFRS that we'll be learning have already adopted, this is what they have in mind. This is what can make you understand those standards. What are the qualities a financial report must have? So in terms, when talking about qualities, they broke that into fundamental characteristics, and we have the enhancing characteristics. So from the name fundamental, it means that if your financial report does not have this one, it's a goner. It is not a financial report. That's why they call it fundamental. While the enhancing characteristics, for this one, if it doesn't have this one, it's still manageable because it's enhancing it. It's just enhancing it. So, for the fundamental, they said there are two of them. They said there are two fundamental: relevance and what? Faithful. There's relevance and faithful representation. And for the enhancing, you have understandability, you have verifiability, you have timeliness, and you have comparability. So these are the qualitative characteristics of a financial report. So let's pick them one by one, because what ICANN does is, there was a diet for 15 marks. They ask you to list and explain the qualitative characteristics. And that was it. So they wanted you to explain all of this. But in most diets, they will just say, explain the following: relevance, faithful representation, comparability. They will just pick those ones and ask you to explain. The wickedest diet is when they say, oh yeah, explain everything. Like that for 15 marks. So you need to be able to do that. Here it is. It's a lot. The conceptual framework itself, I think it's like 150 pages or thereabout. Something you can download online if you just check it. If you wish to read the entire whatever. And I think in my notes we have like 22 pages or 30 pages, something like that. We have summarized it for you. Okay, let's quickly pick them one by one, focusing on what is relevant to you for your exam. Let me start with the fundamental characteristics. These fundamental characteristics is looking at what makes the financial report useful, which means that if your financial report lacks these characteristics, it is not useful. Forget about it, it's not useful. But the enhancing, it makes it more useful or less useful. If he has it, then it's more useful. If he doesn't have it, less useful. Then let's pick the first one, which is what? Relevance. So these fundamental characteristics of relevance, it means that your financial report must be capable of making a difference in the decision that is made by users. The key word there is that it is what? Is capable of making a what? A difference in your decisions. When you pick a financial report, it needs to be able to inform your decision. If you want to, meaning that if you are making a decision before, a financial report should be able to change your mind or for you to maintain your position, depending on what is there. Capable of making a difference. And for it to be able to do that, it means that it should have predictive value and what? And confirmatory value. It means that financial report must have predictive value and confirmatory value. For it to be capable of making a difference, it must have predictive value. It must have confirmatory value. So, and predictive value from the name, it means that we should be able to use it to make what? Predictions. Confirmatory value, it should be able to confirm our past predictions. That is what these two means, predictive value and confirmatory value. And you see, when it comes to a report making a difference, you know, report deals with numbers, majorly figures. And there will be some transaction that the numbers are very small, while there are some that they are very large in amount. Of course, you know that the one that would be relevant are those that are large in amount. So when we are talking about relevance, then of course, we cannot ignore materiality. So what really determines relevance is the materiality of an item. Okay, so the one that is, those ones that are relevant, those ones that are relevant are the ones that are material. That if you omit it or misstate it in your books, it will influence whatever decision users are making. So relevance is determined by what? Materiality. They go hand in hand. And that is the explanation of relevance. So if the examiner say explain relevance for 2 marks, tell them this, you get your 2 marks because you have mentioned everything. Again? Everything I've mentioned there, you must mention it. If financial report is relevant if it is capable of making a difference in the decision made by users, which means that it must have predictive value, and confirmatory value. And from this, predictive value means you should be able to use it to make predictions and you should confirm your past predictions. Relevance is determined by materiality. And materiality means if you omit or misstate an item, it will affect the decision that is made by users. That's the sequence. You have completely explained relevance. The second one is faithful representation. The second one is faithful representation. And faithful representation means that your financial report must present what it purports to represent, meaning present just your economic activity, nothing more. Present what it purports to what? Represent. Because what it's representing is just these asset, liabilities, income, and expenses. Don't present beyond that. Don't overstate. Don't do what you're not supposed to do in your report. So present those items faithfully. So that means these guys expect us to be faithful, right? It's okay. They know we won't be faithful. So they say that what we mean by that is that your financial report must be complete. Your financial report must be neutral. Your financial report must be free from what? Errors. This is faithful representation. Your financial report must be complete. It must be neutral. It must be free from error. And when your financial information or report is complete, it means that all the transactions, all your economic activities are captured there. And even if there are some occurrences or transactions that cannot be expressed in figures, disclose them in the notes, explain them to users, but make sure that every of your economic activities are represented, complete. Capture the whole of the information. We don't want any omission. Second one is neutral. When you are presenting your financial report, you should not be biased. You should not be biased. Don't have a mindset when you are presenting your report. Don't say, I want the investor to know that we are doing well. You already have a target of what your accountant must put in the books in mind. No, you cannot work that way. Is that your economic activity? If it is yes, then fine. If it is not, forget that mindset. You cannot be neutral. Okay, sorry. You have to be neutral. You cannot be biased. And you see, to further explain neutrality, they brought back what we call prudence. In order to explain neutrality, they brought back what we call what? Prudence. And when we say prudence, what we are saying here is this. Prudence is saying don't overstate or understate any of this financial information. Your assets, your liabilities, your income, and what? That's prudence. And in developing this IFRS, all of them have inculcated prudence. They have all inculcated it in such a way that you are measuring most of these items so that you will not overstate or understate your books. All of these standards have actually they have captured this whole thing. The last one is free from errors. You see, when we say free from error, we are not saying that the figures should be accurate. Our figures are not accurate in financial reports because we make use of we make use of estimates and judgment because it's principles. So our figures cannot be accurate. So when we say free from error, listen up. When we say free from error, what we mean that the process of calculating your figures, the process of determining your figures must be free from error. It's the process we are talking about. Your double entry should not be wrong. It should be done correctly. The process of determining your figures must be right. And also, when you are describing or explaining your organization and your transaction, it should be free from error. Don't make error. Explain it very well. Describe it very well. So, free from error here is talking about what should be free from error is the process of determining figures. And when you are describing your processes, when you are describing your organizations, when you are describing your transactions, they should be free from error. So, process and description is what we expect to be free from error. So, there's no way, if you want to get 2 marks in the exam, by explaining faithful representation, first, introduce it the way I have introduced it. That your financial information must present what it purports to what? Represent. And it means that it must be complete, neutral, and what? Free from error. Then explain it 3. You get your 2 marks. That's faithful representation. Is there any of you that have heard of substance over form in this class? Yes? What is it saying? Let me finish it now. Still under faithful representation. Pelumi, you have heard of substance over form before. What do you think it is?
Substance over form is like you presenting the real economic impact of a particular transaction or input rather than just stating words, the legal terms for it. So you present what exactly it is.
Okay, good attempt. Good attempt. So you said that you should present what the transaction is rather than the legal aspect of it. I mean, that's very well. So the first thing I need you to know, in addition to what you have said, is this. The full word, substance over form, is actually economic substance over legal form. Okay? Economic substance over what? Over legal form. So there are 2 phrases here, right? 2. Number 1 is economic substance. And number 2 is what? Legal form. What we are saying here is this. We are saying, when we say substance over form, we just shorten this to substance over form. We are saying, as far as reporting is concerned, we we recognize transactions. I mean, for us to faithfully represent, our transactions must be recognized in accordance with their what? Economic substance. Okay? We don't use legal form. No. We don't follow legal form. We follow what? Economic substance. And when we say economic substance, what does that mean? When we say economic substance, it means that when you are recognizing those financial information I wrote here, assets, liabilities, when you are recognizing them, any transaction at all, make sure you are presenting the financial and economic reality. You are presenting the what? The financial and economic reality. What does that even mean too? When we say economic substance means that present the financial and economic reality. What does it mean? I'll give you two examples to explain that. Economic and financial reality. Two scenarios. Number one scenario is when you have a lease transaction, for example now. When you have a what? A lease transaction. You see, in a lease transaction, it means you rented an asset. You being a lessee or the tenant, you rented an asset to use for your company. And that asset is now making money for you. The standard, what economic substance means is that even though the asset is not your own, but the reality is that the asset is making money for you. As far as we are concerned, recognize that asset in your books. Even though it is not what? Yours. Recognize it in your books because that's the economic and financial reality. The reality here, we don't care about who owns it. The substance, the economic and financial reality, the reality is that you are using it. This thing is making money for you. It's your asset as far as accounting is concerned because that's the substance. Right? That's example one. So, recognizing an asset that is not yours in your books because it's making money for you because that's reality. Example two, let me give that with respect to sales of goods. Let's say you sold goods now. I sold goods to her. Ordinarily, I should recognize sales, Abi. But I now sold it to her. I now told her that these goods I'm selling to you, I will buy it back from you at 100 naira. Meaning that there is an option to repurchase it at a fixed price. There's an option to repurchase it at a what? Fixed price. Economic substance says that the reality of that transaction is that I have not sold to her. I only told her to hold it for me. I will collect it back later. The reality is that I have not sold because I sold and I'm saying I will buy from you at a fixed price. How are we supposed to know that the fixed price you want to buy is realistic? When you have already fixed a price to buy it back. It might not be realistic. So we don't rely on that. If you have sold and you say, okay, I will buy it back from you at the fair value there, at the market price, at whatever price she wants to sell it to you, which is market price, then that's fine. No problem. We are still going to recognize that your sales are sales. But by the time you sold to somebody and you say you buy it back at a fixed price, you cannot recognize that as sales. You have not sold. Okay? We will not allow that to be recognized at what? At sales. Because the reality is that you did not sell. You did not sell. It's just like you sold and you still want to be using it, something that you have sold. Right? So, in accounting, what we recognize is the what? Economic substance. Not the legal form. We have nothing to do with the legal form. Who owns an asset? What the contract is saying, that is not our bit. Even though in most cases, the reality is that we find out that in most cases, legal form and substance, they are the same. In most cases, you find out they are the same. But when we have a scenario where they are different, what do we go for? Economic substance, which is the reality. We recognize the economic and financial what? Reality. And that's substance over form. And there is no way you can faithfully represent if you don't recognize transactions in accordance with the economic substance over what? Legal form. Okay. That's fundamental characteristics. Then, the enhancing, this one, it either makes it more useful or less useful. So things like understandability, it means that it must be simple to understand by users. That's what it means. It must be concise and easy to understand by users. But they mention that users are those with reasonable business and accounting knowledge and who is also willing to study the financial reports. So don't say because you are an investor, then you might not be a user in this context though. Because a user is someone with reasonable business and accounting knowledge and who is willing to understand the financial report. So these are the people we are talking about when we say it should be understandable. It should be understandable to those people. Timeliness. Present it when it is required. Like listed companies now, they are required to present their annual reports by March. They should present it to SEC. You're supposed to present it to FIRS before the end of June, mostly 6 months after your year end. All companies, right? So FIRS. So this timeliness is key. If you are late, it becomes a problem. There will be regulatory sanctions. Investors might not be happy and all of that. So timeliness. Provide it, present it when it is needed. Verifiability. Verifiability means that we should be able to recalculate and recheck your figures. We should be able to recalculate and recheck your figures. And how is that possible? If you present in your statement of financial position that your PPE is 100 million, there should be somewhere in the notes that would explain how you got that 100 million. We should be able to check it and understand it. That okay, this is the cost, this is depreciation, this is how I determine the depreciation. This you explain everything. That makes it verifiable. Then finally is comparability. You should be able to compare your financial reports with another entity's financial report, of course, in similar business. And we should be able to compare this year with previous year. I mean, all these I'm talking about have been incorporated in all these standards. These are the principles they use in developing IFRS. Most IFRS, they aim towards comparability. All of these things that I've explained, that is what all these IFRS is all about. Because that's the principle behind them. So understanding most of these concepts we are talking about is key. And that's the chapter 2 of the conceptual framework.